Imagine an investment, one that offers, higher, more stable income than common stocks and gives you a higher claim on assets if things go south.
Yeah.
But it's definitely not a bond.
Sounds good.
Right. It sounds pretty compelling, yeah.
Yeah.
Especially if you're looking for that steady income. But, well, there's always a catch.
Always.
With anything that sounds this interesting, there are real trade-offs and layers of complexity just hiding under the surface. Welcome to the deep dive.
Hey there.
Today, we're really pulling back the curtain on a fascinating, sometimes frankly overlooked asset class here in the U.S. market, preferred stocks.
Yeah, they don't always get the spotlight.
Not at all. We've gathered a solid stack of sources for this deep dive. Everything from guides by Simply Safe Dividends and CapTrader, insights from Investopedia, Wikipedia, even a little market update flavor from Infrastructure Capital Advisor.
Just a broad view.
Exactly. Our mission for this deep dive is to truly unpack preferred stocks. We want to figure out precisely what they are, where they fit, in that corporate hierarchy.
The pecking order.
Right. How they stack up against the things you're probably more familiar with, common stocks, bonds.
Mm-hmm.
We'll explore the surprising variety of forms they come in. And most crucially, dig deep into the pros, the cons, and the essential homework you absolutely have to do before even thinking about adding them to your portfolio.
Yeah, that homework part is key.
We want to give you the nuanced knowledge, to decide if these hybrid securities just might, fit your specific investment goals. So we'll start by defining them, their unique place, then jump into the critical distinctions compared to common stocks and bonds.
Okay.
We'll look at different types, specific features that matter, tax implications, which can be interesting, how you actually buy them, and then wrap up with that absolutely essential due diligence. Get ready.
Let's do it. Okay, so let's really unpack this. At their core, preferred stocks, sometimes called preferred shares or just preferreds, they're a special class of equity.
Right, equity, but different.
Very different. Unlike common stock, their characteristics really blend aspects of both equity and debt. And that's precisely why they're called a hybrid instrument.
Hybrid, okay.
Like common stocks, yeah, they represent ownership in a company, they trade on exchanges. But here's where the bond-like stuff comes in. They typically promise a fixed dividend payment.
Like a coupon on a bond.
Exactly like a bond's coupon.
Yeah.
And they're usually issued with a par value, often $25 a share in the U.S. market.
So not quite stock, not quite bond. This fascinating mix, that hybrid nature seems absolutely central. And where do they actually sit in that corporate hierarchy you mentioned, the capital stack?
The capital stack. Yeah, understanding this is really fundamental if you want to grasp the risk and priority of preferreds. Imagine a company's structure, like a ladder or a stack, right?
Right.
Representing different types of investors and their claims on assets and earnings.
Okay.
At the very top, holding the strongest position, highest priority, that's the bondholders. All kinds of debt. Senior secured, backed by assets, down to junior unsecured, still ranking above any equity.
Right. Debt gets paid first.
Always. Below the bondholders, that's where preferred stock lives. It is senior, higher ranking claim than common stock, but it's explicitly junior or subordinate to all forms of bonds the company has issued.
So in the absolute worst case, like bankruptcy, liquidation, that order is crucial.
Precisely. In that really dire situation, the company sells off assets and the cash gets handed out according to this hierarchy. Bondholders get paid first up to what they're owed. If there's anything left after the bondholders are whole,
Yes.
then the preferred stockholders have the next claim on those remaining assets. And only after the preferreds are paid their full par value does any leftover value go to the common stockholder.
Who often get wiped out.
Sadly, yeah, they often end up with nothing in liquidation. So having that higher claim than common stockholders, that's a significant protection for preferred investors.
And this priority, it isn't just for liquidation, right? It applies to dividends too.
Absolutely. And this, for many income investors, is maybe the most compelling feature. A company with preferred stock outstanding must pay the stated dividends on that preferred stock before or at the same time as it pays any dividends on its common stock.
Okay.
So if a company needs to save cash, cuts dividends, the preferred dividend has to be cut after or alongside the common dividend, never before.
So much more reliable income stream than common dividend.
And much more reliable. Common dividends can be cut or suspended much more easily by the board.
Okay, that priority is clear.
Well,
so given these features, why would a company even choose to issue this hybrid thing instead of just, issuing more common stock or taking on more debt? What's the angle for the issuer?
That's a great question. And there are actually several pretty compelling strategic reasons. The most obvious one, as you said, is just raising capital.
Need money.
Companies always need funding, expansion, acquisitions, R&D, shoring up the balance sheet. Preferreds offer another way to tap into investor capital. Now, a primary reason for choosing preferred over debt is the impact on the company's credit rating and its leverage profile.
Ah, the ratings agencies.
Exactly. Issuing more debt directly increases total liabilities, usually raises the debt-to-capital ratio. If a company takes on too much debt, S&P, Moody's, Fitch, they might downgrade the rating on existing bonds.
Making future borrowing more expensive.
Significantly more expensive, maybe even limiting access to debt markets. Issuing preferred stock, though, is often treated differently by those agencies. While it's still a claim, it's not typically counted dollar for dollar as debt in the same way.
Interesting.
So it lets them raise capital without inflating their reported debt quite as much, potentially helping maintain, maybe even improve, their debt-to-capital ratio and credit standing.
That's fascinating. It's capital, but it kind of sits in a spot that can look better on the balance sheet leverage-wise than pure debt. How about compared to issuing more common stock? Why not just do that?
Well, issuing new common shares can be tricky for existing shareholders because it dilutes their ownership.
Right, more slices of the pie.
Exactly. You're increasing the total shares outstanding, so each existing share represents a smaller piece. This dilution can potentially push the common share price down. Plus, when companies issue big blocks of new common shares publicly, they often have to sell them at a discount to the current market price to attract enough buyers.
Which annoys existing shareholders.
You bet. Preferred shares, though, they trade as a separate class. Issuing new preferreds generally doesn't cause the common share price to fall because it doesn't immediately change the voting power or ownership percentage of existing common shareholders in the same direct way.
Okay.
And another point is the cost structure. Preferred shares have that stated, typically fixed dividend rate. So the cost of that capital to the company is fixed and predictable over time. Doesn't matter how much earnings grow.
Whereas common dividends might grow over time.
They often do if profits increase, which means a potentially rising cost for the company. The fixed dividend on preferreds offers cost certainty for the issuer.
So it's a versatile tool. Raise capital, manage debt ratios, avoid common stock dilution, potentially cap dividend costs. Okay, now let's really drill down on that first big comparison. Preferred stock versus common stock. You said income, total return, risk, all significantly different. Let's lay that out.
Yeah, they are fundamentally different beasts, even though both are technically equity. If we look across key areas like voting rights, dividends, price potential, rank in insolvency, interest rate dependence, the differences become super clear.
Let's start with voting rights. Common stock usually means you get a say, right?
Generally, yes. Standard common stock comes with voting rights, usually 1 vote per share.
Right.
This lets common stockholders participate in big decisions, electing the board, approving mergers, major policy changes. That's their ownership control.
Okay.
Preferred stock, on the other hand, usually no voting rights. As a preferred shareholder, you're basically just providing capital. You typically don't get a say in running the company.
Oh, say. Are there exceptions?
There are, definitely. Some preferreds might gain voting rights if the company falls way behind on paying the preferred dividends. That's a strong incentive for the company to pay up. Others might get special voting rights on huge corporate events that directly affect the preferred terms, like a takeover. But standard preferred, no vote.
That's a major difference for investors who want influence. What about dividends? This seems like the core appeal of preferreds for many.
Exactly. Dividends are where preferreds really shine for income investors. Common stock dividends, they're variable, totally depend on profits and what the board decides.
They can cut them anytime.
Anytime. Cut, suspend, eliminate if they feel they need to.
Yeah.
The investor's main recourse is usually just selling the shares. And while common dividends can grow over time, they lack that certainty.
Okay.
Preferred stock, by contrast, is issued with a stated, usually fixed dividend rate. Set at issuance usually doesn't increase. Now, to compensate investors for that lack of dividend growth,
The yield is higher up front.
generally, yes. The initial yield on a preferred is usually higher than the yield on the company's common stock when it's issued. And critically, as we said, those preferred dividends have priority. Preferred shareholders must get their full stated dividend before any dividends go to common stockholders.
And there's that crucial distinction you mentioned earlier about missed payments, cumulative versus non-cumulative. Can you unpack why that's so vital?
Oh, this is extremely important, especially for gauging income security. Cumulative preferred stock means if a company misses a preferred dividend payment, that obligation doesn't just vanish.
It stacks up.
It stacks up. It accumulates as dividends in arrears, basically back pay owed. The company must pay all those accumulated preferred dividends before it can pay even a single penny to common stockholders.
Wow, that's real leverage.
It's a significant layer of protection during tough times. Non-cumulative preferred, though, very different story. If a payment is missed, poof, it's lost forever. No obligation to pay it back later.
No.
And this type is actually pretty common in specific areas, like bank preferred stock, often due to regulatory rules like those BIS rules for Tier 1 capital. Things like TRPS, which were big before '08, were often non-cumulative.
So checking cumulative versus non-cumulative is step one of the homework.
Absolutely fundamental, non-negotiable.
That cumulative feature sounds like a strong safety net. How does the volatility and overall risk compare between common and preferred?
Common stock is generally much more volatile. Its price swings wildly based on market mood, economic news, company results, headlines, you name it.
But it has that growth potential.
Big potential for price appreciation, yes. That's the main draw for many stock investors. Preferred stock, generally less volatile than common. Its fixed dividend and higher rank provide some price stability. Its value is tied more to interest rates and the company's credit health than immediate growth prospects.
But less upside potential. Substantially lower potential for price appreciation compared to common. Its price tends to hover closer to its par value, moving mostly with interest rates and credit quality. The income stream from preferreds tends to be more secure, especially for companies with high payout ratios or lots of leverage. Think REITs, MLPs, BDCs.
Right. In those cases, the common dividend might be shaky.
Exactly. The common might be more vulnerable to cuts in hard times, making the preferred a safer way to get high yield from that specific company.
Okay, so common. Growth potential, voting, variable dividends, but high volatility, lowest priority. Preferred. Income stability, higher initial yield, dividend priority, less volatile, better claim, but usually no vote, limited growth.
Got it. Now let's shift to preferred versus bonds. Both income plays, right? How do they differ?
Right. Both appeal to income seekers, but their risk profiles and structures are quite different. Key things to compare: yield, rank in insolvency, price fluctuations, especially with interest rates, any right to a say, and growth potential.
Okay, capital stack first. Bonds are king.
Bonds are at the absolute top. Highest priority claim on assets in bankruptcy. That seniority is why they're generally seen as the lowest risk for permanent capital loss, assuming the company doesn't completely vaporize.
Right.
Preferred stock, while senior to common, is subordinate to bonds. Bondholders get paid first, in full if possible, before preferreds see a dime in liquidation.
Highest safety for bonds in default. What about the income and yield?
Bonds give stable returns via fixed interest to coupon payments. Because they're lower risk, bonds typically offer lower yields than preferreds from the same company. That's the safety premium.
And preferreds?
Preferreds often offer higher dividend yields than bonds. Dividends are usually fixed, feels a lot like bond coupons, but potentially at a higher rate to compensate for being lower on the latter than bonds.
Any difference in handling inflation? Does either protect you?
Generally, traditional fixed-rate bonds offer no built-in inflation protection. Those fixed coupon payments buy less and less as inflation rises, eroding your real return.
Except for things like TIPIX.
Right. Treasury inflation-protected securities are the exception, where the principal adjusts. Preferred stocks, with their fixed dividend, are similarly vulnerable to inflation eating away purchasing power. The sources don't really mention any inherent inflation protection, so that fixed income stream also loses real value in inflationary times.
Okay. Interest rates are huge for bonds. How do they hit preferreds? Is it the same impact?
Interest rate sensitivity is a really critical comparison point here. We know when market rates rise, existing fixed-rate bond prices fall. When rates fall, bond prices rise.
So the yield matches the market.
Exactly. The price adjusts. And longer duration bonds, those maturing way out in the future, are way more sensitive. That example of a 30-year treasury dropping 25% if rates go from 3% to 4% shows that.
Wow. What about preferreds?
Preferreds also have significant interest rate sensitivity. That fixed dividend looks like a coupon. So when market rates rise, preferred prices tend to fall to make their yield competitive. However, they're often less rate sensitive than long-term bonds.
Why is that?
Because many preferreds have a call date. The company can redeem them, often within 5 or 10 years. That callable feature gives them a shorter effective duration than, say, a 30-year bond. But make no mistake, their price can and does fluctuate significantly with rates. Just maybe not the extreme swings of very long bonds.
So less sensitive than long-term bonds, but still pretty sensitive. Got it. What about overall volatility and risk compared to bonds?
Bonds are generally seen as less volatile than preferreds. Why? Seniority in the capital stack and interest payments are usually seen as more certain than even preferred dividends.
Okay.
Bond prices move, mainly with rates and credit risk, but typically less dramatically than preferreds. That 2008 crisis example is powerful. Treasuries gained value, flight to safety. Corporate bonds had small losses. Even junk bonds generally fell less than many preferred stocks, which tanked by up to 50%.
50%, wow.
Yeah. It shows that even with less rate sensitivity to long bonds, preferreds can be more volatile overall, partly due to being junior to debt, maybe lower trading liquidity, greater sensitivity to credit risk perceptions.
You mentioned maturity for bonds. Do preferreds mature? Do you get your principal back?
Most U.S. prefers are issued without a fixed maturity date. Technically, they're perpetual. The company isn't obligated to return your capital on a specific date.
So you only get it back if?
Only if the company liquidates, or, much more commonly, if the shares are called by the issuer. As we discussed, that call feature is super common. So while they could last forever, the call date often limits their practical lifespan for an investor. You can't assume you'll hold them forever.
Unlike a bond with a clear maturity date.
Exactly. Bonds have that defined date when the principal is repaid.
And finally, practically speaking, how easy is it to actually buy these things individually?
For individuals, buying individual bonds can be tough. Corporate bonds often trade in big chunks, $1,000, maybe $10,000 or more. Makes diversification costly. Treasuries, too, often $10 increments.
So most people use bond funds or ETFs.
Right. Preferred stock, though,
Yeah.
often much easier for individuals to buy directly. You can usually buy individual preferred shares through your regular broker, just like common stock, often in $25 increments at par.
Okay, so quick summary of the comparisons. Bonds, highest safety seniority, stable fixed income, usually lower yield, high rate sensitivity, long-term maturity date. Common stocks, highest growth potential, voting, variable dividends, lowest priority. Preferreds, sit in the middle. Higher fixed income than common, often higher yield than bonds. Dividend priority over common, less volatile than common, but more than bonds. Usually no vote, limited growth, big callable risk, rate sensitive, subordinate to bonds but senior to common, and easier for individuals to buy than individual bonds.
That really nails their position. Now, you mentioned earlier not all preferreds are created equal. There's this fascinating variety of types and features. Adds crucial complexity. What are the big variations investors need to know?
Yeah, beyond the basics, understanding the specific terms is totally non-negotiable. We already hit cumulative versus non-cumulative hard,
Super critical.
just to hammer it home. Cumulative means missed dividends pile up, must be paid before common gets anything key safety feature. Non-cumulative means missed dividends are gone forever, big hit to income security.
Always check that cumulative box. Okay, what about participating preferred? That sounds different.
It is. Participating preferred offers the holder a shot at extra dividends on top of the fixed stated dividend.
A bonus.
Kind of. It usually kicks in if the company hits certain preset financial goals like smashing an earnings target or paying a certain level of common dividend. It's a way for preferred holders to maybe share in extraordinary profits. Adds a bit of upside you don't get with standard preferreds.
Interesting. Fixed income plus a potential kicker. Now, convertible preferred, this one often appeals to growth folks looking for a blend, right?
Exactly. Convertible preferred gives the holder the option, keyword option, not obligation to swap their preferred shares for a set number of the company's common stock shares.
Preferred into common.
Usually just one way, yeah. The appeal is trying to combine the relative safety and steady income of preferred with the potential growth upside of the common stock. It's for investors who want some potential upside without immediately taking on the full risk or volatility of owning common outright.
So how does that conversion actually work? Is it tied to market prices?
Yeah, it's based on a defined conversion ratio, how many common shares you get for each preferred share. The sources had an example, company XYZ. If the ratio is 6.5, you swap one preferred for 6.5 common. You can also figure out an implied conversion price for the common.
Okay.
That's the price the common needs to hit for the value you get converting to equal what you paid for the preferred. It's the preferred price divided by the conversion ratio. So in that XYZ example, $100 preferred price, 6.5 ratio, the conversion price is $15.38. So you only convert if common is above $15.38.
Generally, yeah, that's when it becomes profitable. If the common price is way above the conversion price, the convertible preferred will trade more like the common stock it converts into. If the common is way below, the preferred acts more like a regular preferred price driven by yield, rates, credit quality. Are there downsides or nuances with convertibles for the investor?
Oh yeah, trade-offs. When convertibles get converted, it increases the number of common shares out there. Dilution waters down existing common shareholders.
Right. Also, even though they offer that common stock upside link, convertible preferred holders rarely get voting rights, unlike the common shareholders they might become. And while the price gets tied to common performance, that fixed dividend part means they're still affected by interest rates, like bonds and straight preferreds. Their complex need to understand both the equity and debt-like sides. Okay, convertible makes sense. Now, maybe the most talked about feature, especially for individual issues, callable or redeemable. This is where the company holds a big trump card.
It really is. Callable preferred gives the company that issued them the right, importantly, not the obligation to buy back or redeem the shares from investors at a preset price after a defined date.
Forced buyback.
Essentially, yeah. The price is almost always par value, usually $25 in the US. The date is the call date, all spelled out in the prospectus for that specific series.
So the company can force you to sell back after a certain date. Why do they want that right? What's the advantage for them?
It gives the company huge financial flexibility, especially dealing with changing interest rates or their own credit situation. Imagine they issued preferreds with a 7% dividend when rates were high.
Okay.
If later market rates or the required yield for their credit rating drops significantly, say to 4%, they can call back those expensive 7% shares by paying investors $25 par. Then they can issue new preferreds at the lower current 4% rate. Lowers their cost of capital.
Exactly. Refinancing, basically. And if rates go up after they issue, you just don't call the shares. They're protected from rising costs on that specific issue.
Clear win for the issuer. What about the investor holding callable preferred?
For the investor, well, you get that steady fixed dividend until potentially called. But the main risk, once that call date passes, is reinvestment risk.
Ah, yeah.
If your shares get called at $25 par, you get your principal back, sure. But then you have to reinvest that money in the market, likely at lower prevailing rates.
Yeah.
That can really sting if you were counting on that income stream.
Mm-hmm.
Issuers sometimes pay a small call premium, maybe slightly above par, to soften the blow, but it often doesn't fully make up for reinvesting at lower yields. Basically, buying a callable preferred means giving up some common stock upside for that greater income security until the call date. Citigroup Series S redemption was mentioned as a real-world example.
So watching that call date and call price versus the current market price is absolutely critical.
Crucial. Especially if you buy a callable preferred trading significantly above its $25 par value. If the company calls it at par, boom, capital loss. You have to calculate your potential return, assuming it might get called. Factor in dividends until the call date versus that potential capital loss.
You also mentioned perpetual preferred. Does that mean it literally lasts forever?
Theoretically, yeah. Perpetual preferred has no fixed maturity or redemption date. The company never has to return your capital unless they liquidate or, well, unless they choose to call the shares.
Ah, so even perpetuals are often callable.
Extremely common. Most U.S. preferreds are structured as perpetual, no mandatory maturity, but the callable feature is almost always there. So while they could exist forever, the company's right to call them often limits their practical permanence. You can't just assume you'll hold it indefinitely. That JP Morgan Chase Series W example. Technically perpetual, but also callable.
And quickly, any other less common types worth a mention?
Yep, a few you might hear about, though maybe less frequent for typical investors. There's prior preferred stock, highest priority among a company's different preferred issues. They have multiple series. Preference, preferred ranks below prior preferreds. Putable preferred gives the holder the right to force redemption under certain conditions, kind of the opposite of callable.
Investor holds the power there.
Right. And monthly income preferred stock, often a specific structure combining preferred and subordinated debt features to pay monthly, not quarterly. Just shows how customized these can get.
Okay, the complexity is definitely clear with all these variations. Let's shift gears now to something investors can't avoid, taxes.
Yeah.
How are preferreds treated for U.S. investors? Any advantages there?
This is actually a pretty significant advantage for many individual U.S. investors holding preferreds in regular taxable accounts. The key thing is how the dividend income gets taxed compared to, say, bond interest. For most preferred dividends issued by standard C corporations, regular companies, not pass-throughs, these dividends typically qualify for taxation at the lower long-term capital gains rates.
Qualified dividend.
Exactly. commonly called qualified dividends.
And that's different from how most bond interest is taxed, or...
Totally different. Most bond interest corporate bonds, Treasuries gets taxed at your ordinary marginal income tax rate. For many people, especially in higher brackets, that ordinary rate is way higher than the long-term capital gains rate.
So you keep more after tax?
Potentially, yes. You could get the same pre-tax income from a preferred as a corporate bond, would pay substantially less tax on the preferred income, leading to a higher after-tax return. The sources highlight this, contrasting those marginal ordinary rates with the lower long-term cap gains rates, currently 0%, 15%, or 20%, depending on your income. Plus, don't forget that extra 3.8% Affordable Care Act surcharge on investment income for higher earners.
Are there exceptions? Do all preferred dividends qualify?
No, and this is a crucial homework point. Dividends from preferreds issued by REITs, real estate investment trusts, and other pass-through entities, like BDCs, business development companies, typically do not qualify.
Ah, okay. Tax like bond interest then.
Exactly. Taxed at ordinary income rates. So while REIT or BDC preferreds might look attractive yield-wise, they often lack that tax advantage compared to a C Corp preferred. The main exception for tax-free bond interest is municipal bonds, of course.
What if you hold preferreds inside a retirement account, like an IRA or 401k?
Well, holding them there defers taxes until you withdraw the money in retirement, which is good. But when you do take withdrawals, including those RMDs later on, that money is generally taxed at ordinary income rates.
So you might lose the qualified dividend benefit.
Potentially, yes. You lose that lower tax rate you'd get in a taxable account. Unless it's a Roth IRA, of course, qualified Roth withdrawals are tax-free, so you keep the benefit there.
And if you sell a preferred share for a profit...
Capital gains from selling preferreds. Taxed just like gains from selling common stock. Hold less than a year. Short-term gain, taxed at your ordinary rate, hold over a year. Long-term gain, taxed at those lower capital gains rates, 0, 15, 20%, plus maybe the surcharge. So bottom line, for many U.S. investors in taxable accounts, that potential for qualified dividends from C Corp preferreds is a very real tax advantage over getting the same income from typical corporate bonds.
That tax angle is definitely appealing, an important piece of the puzzle. So if an investor decides these might fit, how do they actually go about buying preferred stock?
Primarily, two main ways for individuals. First, buying individual preferred shares directly. Second, buying shares of a preferred stock fund or ETF.
Okay, individual shares first. How's that work?
It's done through a standard brokerage account, just like buying common stock. But you need to know they often list differently, not just the company ticker.
Right, you mentioned those letters.
Yeah, often the ticker followed by a letter or series ID like all H, all I, all J, for a different Allstate preferred series. Each series has its own specific terms, dividend rate, call date, cumulative feature, everything.
What are the pros and cons of buying them individually?
Main pro is direct control and visibility. You know exactly which company, you can research its health, you know the precise terms of your specific share, the dividend, cumulative status, call date, price. You also control when you buy and sell for tax management.
Makes sense. The cons.
The big one is diversification, or lack thereof. If you only buy individual preferreds from a handful of companies, you're really exposed if one gets into trouble.
Income stops, capital loss.
Exactly. Buying individual preferreds means serious homework on each specific issue and its issuer.
And the alternative, buying a fund or ETF.
Right. Very popular way to get exposure. Products like the iShares Preferred and Income Securities ETF, ticker PFF, is a big one to mention. You buy shares of the fund or ETF, and you own a piece of diversified portfolio, potentially hundreds of different preferreds from various companies.
So the big pro is diversification.
Huge benefit. Dramatically gets the risk of one company's problems sinking your investment or income. But there are drawbacks compared to individuals.
Such as?
Preferred stock funds basically create infinite duration risk for the investor.
Infinite duration? How?
Because the fund always holds preferreds. When older issues in the fund get called, the managers reinvest that cash into new preferreds available on the market at whatever the current rates are. This constant reinvestment means the fund's price and its payout are highly sensitive to long-term interest rate changes, similar to a very long-duration bond fund.
So more price volatility in the fund shares.
Can be, yeah, compared to owning a single callable preferred with a known call date. Also, because the yields of the underlying holdings change as issues get called and replaced, the income the fund pays out can be more variable over time compared to the fixed dividend from a single share you hold directly. The sources noted how PFF's annual dividends have fluctuated, showing this.
Okay. Diversification helps with company risk, but adds more sensitivity to broad rate moves and income variability in the fund structure. It really sounds like if you go the individual route, that homework is just massive.
It's non-negotiable,
Well,
which brings us right to the essential due diligence. The sources are crystal clear. Buying individual preferreds means you must think like a bond investor, not just a stock picker.
rigorous analysis.
There is homework, financial analysis, and frankly, many individuals just don't have the time, resources, or maybe expertise to do that thoroughly for multiple issues.
So thinking like a bond investor, what specific homework are we talking about? What do you absolutely need to nail down for an individual preferred?
First off, understand the specific terms of that exact preferred share. Paramount. They are not all the same. Is it cumulative or non-cumulative?
Right.
Critical for income security. Is it callable? If yes, what is the call date? What is the call price? Usually $25 par. Vital for knowing how long you might hold it and calculating potential return loss if called. Is it perpetual or does it have a maturity date? Most U.S. ones are perpetual, but check. Any other funky features? Floating rate tied to SOFR. You got to read the prospectus or look it up reliably.
Let's revisit that JP Morgan Chase Series W example you mentioned.
Perfect illustration. Fixed annual dividend. 1.575 per share. Yield around 6.1% if trading near $25.97. Technically perpetual, but key point callable by JPM after Sept 1st, 2019 at $25 par.
So if you buy at $25.97,
You're paying almost $1 over par. You get the dividends, sure, but if JPM calls it, they pay you only $25. That's a capital loss of 97 cents per share, minus maybe any accrued dividend up to the call. The source calculated even after one quarterly dividend, your cost basis might still be around $25.18. Still a slight loss if called at $25.
so even with a rock-solid company like JPM, buying above par on a callable preferred means you could lose capital if it gets called, offsetting the income.
Exactly. That example perfectly shows preferred doesn't mean risk-free principal. You must understand call risk relative to your purchase price.
That really hits home. Preferred doesn't mean safe.
Precisely. Beyond the specific terms, you also need fundamental analysis of the issuing company's financial health. Is the company making enough money, enough cash flow, to comfortably cover its debts and its preferred dividends?
Dig into the financials.
You bet. Look at sales, earnings trends, balance sheet strength. How much debt is senior to the preferred? What's the common dividend payout ratio? If it's super high, that could signal stress down the line. Tools like dividend safety scores can give a hint, but they're no substitute for looking yourself. You have to put in the time, like a bond analyst, assessing creditworthiness and ability to pay.
That level of analysis for each individual preferred sounds like a massive commitment.
It is. And because of that complexity, the unique risks, callability, rate sensitivity, maybe liquidity issues, financial firms often suggest keeping preferred allocations modest. Janney Montgomery Scott was cited suggesting no more than 10% of your fixed income portfolio.
Not 10% overall, 10% of the bond income slice.
Exactly. That underscores they aren't risk-free replacements for high-quality bonds, despite the name. They're subordinate to bonds, have call risk, rate risk, credit risk, no vote. The name doesn't guarantee safety.
That 10% cap within fixed income is a really important guideline. So putting it all together, who are preferreds generally best suited for, and who should probably steer clear?
Typically best for security-conscious investors mainly seeking stable, higher income than they might get from bonds or common stock. Think retirees focused on cash flow, capital preservation, less on aggressive growth.
But only if.
Only if they truly understand the trade-offs. Limited price appreciation, usually no vote, and all the complexities and risks we've covered, especially call risk and rate sensitivity. Generally not ideal for investors focused on long-term wealth growth via capital gains, or those needing easy liquidity or wanting a say in the companies they own.
Let's look at some real-world examples, maybe globally, to see this common versus preferred structure. Sources mention VW, Alphabet, Six.
Right, those examples, especially the European ones, clearly show the core difference. Voting rights versus dividends, Volkswagen. Ordinary shares vote, preference shares don't. To compensate, VW proposed a slightly higher 2023 dividend for preference, 9.06 versus 9.00.
Okay.
6 SE, similar deal. Ordinary votes, preference doesn't. Preference gets a slightly higher proposed dividend, 3.92 versus 3.90 as compensation.
And Alphabet, Google.
Different structure, but analogous idea. Class A votes, Class B super votes, insiders. Class C has no vote. The public Class C is like a preferred in giving up votes, but without the guaranteed fixed dividend. Its value is all about company performance, like common stock.
And where do we mostly see preferreds issued by U.S. companies? Which sectors?
In the U.S., it's primarily specific sectors. You see them most from large banks and financial institutions. Wells Fargo, BofA, Citi, JPM mentioned. Also REITs, and public utilities.
Not the big tech names like Apple or Microsoft.
Generally not. Apple, Exxon, Microsoft, Amazon typically don't have publicly traded preferreds. That concentration in financials, REITs, utilities is partly due to business models that suit this financing, and especially for banks, regulatory capital needs.
Ah, the Tier 1 capital buffer.
Exactly. Banks were encouraged to issue preferreds for that, particularly post-2008 and Dodd-Frank. Even though some older things like TRUP-Is got phased out for certain capital rules, preferred stock remains key for bank capital structures.
Are preferreds only a public company thing?
No, actually preferred equity is super common in private markets too. Standard in real estate finance and especially venture capital funding rounds.
Series A, B, C.
Exactly. Those are almost always Series A preferred, Series B preferred, etc. In private companies, it's crucial for separating control. Founders often keep common stock votes. From economic interest, investors get preferred. Private preferreds often have big features like liquidation preferences. Investors get their money back first in a sale or IPO, sometimes multiples back. Helps structure deals and protect investors. Can also help keep common stock valuations lower for employee options.
You also mentioned similar yields might be found elsewhere.
Yeah, worth noting, the high yields on preferreds aren't totally unique. You might find common stocks of certain companies paying comparable or even higher dividends. Think high-quality REITs, MLPs, utilities, some telecoms.
But with different risks.
Critically different risks. Those common shares are generally much more volatile than preferreds. And their common dividends, while maybe high-yielding, lack the priority and often the cumulative feature of many preferreds. Similar yield, yes, but typically different underlying risk and income security.
Okay, this has been a really thorough deep dive into U.S. preferred stocks. To wrap it all up, what are the absolute key takeaways for our listener?
Core idea. They're hybrids. Stock and bond features mixed. They offer priority over common stock for dividends and in liquidation, higher up the ladder than common.
Yeah.
They typically give a fixed, usually higher dividend than common, appealing for income, but usually no voting rights. Less volatile than common, but definitely more volatile than high-quality bonds, especially in stress. Callable risk is huge, as is rate sensitivity.
And who should really consider them?
Best suited for security-conscious investors, primarily seeking stable, relatively high income, like retirees focused on capital preservation, income generation, but only if they genuinely understand and accept the trade-offs: limited growth, no vote, and the specific risks, especially callability. Not great for growth investors, active managers, or those wanting a say. The absolute #1 takeaway, especially if you're thinking individual preferreds, not funds. The critical need for extensive due diligence. You must understand the specific terms: cumulative, callable, call date price. And you must analyze the issuer's financial health and creditworthiness.
Got it.
They offer benefits, income, priority, maybe tax advantages, but also unique risks different from stocks and bonds. Subordinate to bonds, call risk, rate credit risk, no vote. While they can be a valid addition for diversification in a sophisticated investor's fixed income slice, that preferred name absolutely does not mean your money is guaranteed safe.
That feels like the most crucial point to hammer home. So here's a final thought. Given all this complexity, the call risk, the intense homework needed for individual preferreds, is that potential slightly higher yield over a quality bond or even a diversified preferred ETF truly worth the effort and those unique risks for the average income investor? Or are there maybe simpler, equally effective, or perhaps just more appropriate ways to hit your income and diversification goals depending on your situation? What stands out to you after digging into all this? Thanks for joining us for this deep dive into U.S. preferred stocks.
My pleasure.
We hope this exploration has given you a much clearer, more nuanced picture of this hybrid asset class and really equipped you with the right questions to ask if you ever consider adding them to your investment strategy.